The market is currently closed. Supermicro closed at $45.80 on Friday, September 19, 2025, with an intraday drop of negative 0.30% from the previous close. The most recent data indicates that this small daily dip, while seemingly insignificant, comes amid a period of pronounced institutional churn and a shifting narrative that is more complex than the simple growth story most retail investors have come to expect. While many people think of Supermicro as a pure-play AI server company, the direct beneficiary of the immense demand for hardware from companies like NVIDIA, and therefore a stock that should move in lockstep with the broader AI narrative, the reality on the ground is a little different. The stock's recent trading behavior, marked by volatile swings and a cooling of the frantic institutional accumulation seen earlier in the year, suggests a more nuanced picture. There's a palpable tension between the company's undeniable role in the AI supply chain and the underlying market dynamics that are currently reevaluating its valuation and future growth trajectory. The initial near-euphoric belief that Supermicro's growth would be almost linear is now being tested by the reality of a more competitive and, frankly, more rational market. This is a company that has been at the forefront of the AI boom, building the essential server hardware that houses the powerful GPUs from companies like NVIDIA stock. Their building block architecture is a key part of their value proposition, allowing for rapid customization and deployment of high-performance computing solutions. For a long time, this was enough. The narrative was simple and compelling. AI needs servers, Supermicro builds the best servers, therefore Supermicro's stock goes up. And for a period it did, in spectacular fashion. However, recent trading sessions have shown that the market is a forward-looking mechanism that constantly seeks to discount future expectations. The stock's performance this past week, in particular, has been a case study in this principle. On multiple days, we've seen it gap down or fail to hold early gains, even on days when the broader technology sector, including names like Apple stock and NVIDIA stock, showed strength. This indicates that while the overall AI theme remains powerful, there are specific company-level pressures and concerns at play here. The high trading volumes on these down days are particularly telling. It's not just retail traders taking profits, it's significant institutional selling and rebalancing that is putting pressure on the price. The institutional ownership data, which is only updated quarterly, gives us a rear-view mirror view, but the intraday trading volume and price action are the real-time indicators of what the big players are doing. There's a quiet but persistent reevaluation happening, and it's manifesting in these daily swings. The market is asking, what does the growth look like from here? And is the current valuation justified by a potentially more competitive landscape? This is where the tension between expectation and reality becomes most pronounced. The expectation is that the company's growth is a sure thing. The reality is that the market is now scrutinizing every quarter's report and every bit of news for any hint of a slowdown or margin pressure. Supermicro's recent earnings report, for example, was a perfect example of this. The company missed on revenue and EPS forecasts, yet the stock initially rose in aftermarket trading. This is a classic sell the rumor, buy the news event, but it's also a clear sign that the market's initial knee-jerk reaction to the headline numbers was a bit out of sync with the underlying sentiment. The subsequent price action, however, saw that gain erode. This kind of volatility is a hallmark of a stock where the narrative is in flux. The company guided for a stronger future, but the market's initial reaction was a kind of shrug, we'll believe it when we see it. The gross margin, which has been a point of concern, also saw a decrease for the full year, a sign that the intense competition and the costs associated with rapid expansion are putting pressure on profitability. This is a critical point that the market is now fixated on. You have a company growing revenue at a rapid clip, but if that growth is coming at the expense of profit margins, the narrative shifts from one of pure, unadulterated growth to one of a trade-off. This is the kind of detail that sophisticated investors, whether they're using an intelligent portfolio from a platform like Schwab or a more hands-on approach with a service like Interactive Brokers, are hyper-focused on. They're not just looking at the top-line revenue figure, they're dissecting the profit and loss statement to understand the quality of that growth. For those less familiar with the company, Supermicro or Supermicro Computer Inc. is a manufacturer of servers, storage systems, and other hardware for data centers and cloud computing. Their business model is built around a concept they call application-optimized total IT solutions, which essentially means they provide a wide range of hardware that can be quickly configured for specific customer needs. Their core strength lies in their close partnerships with chip makers like NVIDIA, which gives them a leg up in the race to deliver high-performance systems for AI workloads. They don't just build generic servers, they build purpose-built, highly optimized machines designed to handle the massive computational demands of modern AI models. This specialization has been a huge driver of their success. However, as the AI market matures, this also introduces new risks. What happens if another company, perhaps a larger, more established player like Dell or HP, starts to compete more aggressively in this space? What if a major customer decides to build its own server hardware? These are the kinds of questions that are now being asked on Wall Street, and they are the root cause of the recent pressure on the stock. The simple growth story is now being replaced by a more complex narrative about market share, competition, and margin preservation. This is where investors need to do their homework, whether it's through a self-investing platform or by getting investment help from a professional. You can't just buy the headline anymore. From a trading perspective, the recent action shows a clear struggle between buyers and sellers. On some days, the stock has traded on massive volume, with millions of shares changing hands. These days often coincide with specific news, analyst ratings, or broader market movements. Other days, the volume is much lower and the stock drifts sideways. This kind of choppy, directionless movement is a classic sign of a market that is consolidating and trying to figure out its next move. The volatility is still high, which presents both opportunities and risks for traders. For a retail investor using a platform like Robinhood or SoFi Invest, the temptation to chase the daily swings can be strong. However, a more disciplined approach, perhaps using a Fidelity brokerage account to manage a longer-term position, would require a deeper understanding of the company's fundamentals beyond just the daily price chart. The technical analysis is showing that the stock is testing key support and resistance levels. A break above resistance could signal a return to its previous upward momentum, while a break below support could lead to a more significant pullback. These technical levels, combined with the shifting fundamental narrative, are what traders are watching closely. The future outlook for Supermicro is tied directly to the continued growth of the AI and high-performance computing markets. The company has a clear runway of demand, but the question is how much of that demand is already priced into the stock. Their ability to secure a first-mover advantage with new NVIDIA products, such as the Blackwell platform, is a significant tailwind. They have a history of being fast to market, and that agility is a major competitive advantage. However, the risks are also real. The overall macroeconomic picture, including interest rates and inflation, could put a damper on corporate spending on IT infrastructure. A slowdown in the broader economy would almost certainly impact Supermicro's business. Furthermore, the competition is not standing still. Dell and HP are not going to cede this market without a fight. Even cloud providers like Amazon and Google are building their own hardware, which could threaten Supermicro's business with some of its largest potential customers. This is the ultimate test of the investment thesis. Can Supermicro maintain its competitive edge and its premium valuation in a world where the biggest players are also trying to get a piece of the pie? This is not just a question for Supermicro. It's a question for the entire AI hardware sector, including the likes of NVIDIA stock. The market narrative has shifted from one of pure supply-side constraints to one of demand and competition, and Supermicro is now at the center of that evolving story. The company's core business model remains sound. They are providing a critical piece of the puzzle for the most important technological trend of our time. They have a proven track record of execution, and their close ties with key partners are a huge asset. However, the expectation of a straight line up is a narrative that has been challenged by recent reality. The reality is that markets are not linear. They move in waves of expectation and disappointment, and right now we are in a period of reevaluation for Supermicro. The stock is finding its new footing, and that process is likely to be volatile. The days of easy gains are probably behind us, and the next leg of growth will be earned through disciplined execution and a clear demonstration of sustained profitability. For anyone considering an online investment in Supermicro, the most important thing is to understand this shift in the narrative. It's no longer just about the AI boom. It's about Supermicro's ability to navigate a maturing, competitive landscape. It's a much more complex and, frankly, more interesting story than it was a year ago. It's the difference between a simple binary bet on AI and a nuanced analysis of a specific company's strengths and weaknesses. Comment below on how you think the intense competition from larger players like Dell and